Hi, this is Peter with Quantum Edge AI. We're going to be constructing the double calendar. And this is a fantastic way to be involved with a trade, have minimal finite risk, and also um, have theta positivity such that you can generate income in a very risk-averse way. Okay, so let's do this. This is the front week, this is the back week, and what we're going to do is construct it using Quantum Edge AI's forecast, high and low forecast, and use it as a guide to place the strikes in this case. So a quick overview for how the double calendar is structured. The double calendar is two different durations, front week, back week. So what does this mean? It means that we're going to sell this duration and we're going to buy this duration. This is a net debit. So, for example, I'll deconstruct the double calendar by having in one calendar and another calendar. So what we can do is we can place, typically this is structured by having a long put. This is a short, this is a short, this is a long, this is a long. But what we're going to do is think about it in terms of the put side and the call side. So two different calendars, sort of like the potential of legging into a strategy where you have, um, you can have the long calendar set up first, and then you can the long call calendar portion set up first, and then the long put calendar set up second. So the way we can do this is say, okay, well, we have the 232 quarter here. So let's buy this calendar, analyze, and take a look. Now, okay. So what do you notice about this specific strategy? It's the single calendar. This isn't a double calendar. This is a single calendar. So what is this? We have delta positivity here. We have a delta long. So in the event we want the market to increase during this time that we own this position, and we want basically the position, the stock itself, to oscillate within this channel. So above this portion, so within this threshold, we have 226 to 240. So this is the Goldilocks zone where you will be profitable in the event that there isn't a serious implied volatility crush. As long as that doesn't happen, that is rare, but it does happen, and that's something you should be aware of. In the event that implied volatility um, goes down substantially, you will lose some capital. But the no matter what, you have finite risk. So let's discuss why you have finite risk. Now, you're selling this. So say the 232.5. We're selling the 55 cent, and we're buying the 134 cent. Now, the contracts negate each other. So 232, you're selling in 232 half, you're buying at 232 half. So the net debit is the difference between these, which is 78 cents. So that is the maximum loss based upon a individual spread. 1, 2, 3, 4, 5. You can multiply this up to 10, let's say, and your net debit would be $780. Now, let's look at the alternative side and say, okay, well, the low forecast is coming in at 222.98. So maybe we want to place this at this location. Buy, analyze, calendar. Now, this is the double calendar using Quantum Edge AI's high and low forecast. What we're going to the reason why we like this is because there is a delta positive here, there's a theta positive, and there's a vega positive. In the event that implied volatility, something unseemly happens, a gap down, a gap up, implied volatility skyrockets, actually you're going to be positive. See the volatility adjustment? In the event of an implied volatility adjustment of 10%, you're going to be actually profitable on this trade. So what is this? This is an interesting way of constructing a trade. Now, you can do it like this. There's a few options you have. So you can construct it in this format such that, okay, you want the target to be 232 half. You can single it out and say, okay, well, you know what? There's a bit of, I'm going to get involved here because I think we're going to shoot back up this way in this direction. The high forecast is over here, and we think, okay, well, this is a likely application for the long calendar. I will have finite risk, 78 cents. We're going to be delta long throughout this time period. Our target is the 232 quarter, or the 232 half in this case. And we think that the delta, the position here, we're going to get long. Our target's here for the next 5 days, and our finite risk of 78 cents is a good position. Now, when this shoots back up, let's say when or if it shoots back up and it comes back to 228.88. Okay, maybe that's when you say, oh, I'm going to leg into my long put, and I'm going to hedge that delta. See what happens here? The delta for the calendar, the long calendar, is 8.99. Well, maybe up here you want to hedge that gain you made, that $30 that you made on the way up. Maybe not exactly $30, so it's not going to be 2%, but let's say it goes back to 228.88. So you've net the theta decay of a day, let's say, that you've been in the position for 24 hours. You've netted this, the 11.63 theta decay, and you've also hit this close forecast location, and you're also positive in the delta. So you can add those two numbers up, and that's um, your expected gain based upon 24 hours of theta decay and also the close forecast being a target. So that's what you want to how you want to construct this trade. You can be risk averse and say, okay, well, I'm going to get out when price reaches this close forecast. Maybe I will, or maybe I can sit in the position and net this the differential here and say, okay, well, I'm going to just hold it because I think that the 232 half is going to be out of the money at expiration. And you know what? I'm also maybe I'll just hold that long stock. So you do have options. You can be long the call and hold this to expiration. You can hold this also. But remember, if you are in the money above the 232 half at expiration, you're going to be short 100 shares of this position, and you're going to still be long this call. So that can be advantageous for you or your portfolio strategy, where you have now, okay, well, this may be in the money, this may be out of the money, and in both situations may be fine for you. Because say, for example, it's out of the money. Well, you net this credit here of 55 cents, and that's golden. Perfect, fine. Oh, say Apple is above this in the money. It's in the money, and you net this credit still, but you are now short the 100 shares. Maybe that is advantageous because you're already hedged that long call. So okay, let's go back into the double calendar. So let's say, okay, well, you have this position now, and you want to just add on to this position in a way, but you want to be risk averse and you want to hedge also. That's where the double calendar aspect comes into it, and you can be also long the put side calendar. Um, the reason why this is beneficial is because now um, you've doubled your theta if you're looking at it at price here, maybe over here you don't, you want to say, okay, 2280, 2280, 228, 228.8, and let's see what the theta decay is when this position is up. So it's a little bit more, and you're maybe expecting prices just oscillate there. That's one reason you need to do this. You can also set up, like I said, like you can also set it up such that the long calendar and the long put is traded immediately. The reason why this is beneficial is because what happens is the region, the threshold for which you are um, profitable is much greater. See the distance between the lower threshold at 220.9 and the higher threshold to 236.4. That is the arena, that is the threshold where you will be profitable in this trade, where your P&L is above zero. See this line here, the red line and the red line. P&L is a positive, and also this is a nice delta neutral strategy that you can be, for the next 5 days, you can be generating theta decay. You have finite risk, and you have a really wide area of being profitable. And you can hold this position until expiration, and you'll be in a good spot. Because even if you do hold it into expiration, it's in the money or out of the money, you're still hedged on the long side, the back week. You can also construct this trade in this format and just say, okay, well, I'm going to buy, analyze buy, double diagonal it says here, but double calendar, and you can construct them individually and say, okay, well, um, I'm going to look at the risk profile, and maybe I'll construct it such that the thresholds are within here. I would advise to put them a little bit further out, the thresholds to be over here and over here, so it give you a little bit more wiggle room, because these are targets. This is the high forecast and low forecast. This is where price should reach. So you want to be outside of these thresholds. So you can actually construct it individually and say, okay, well, I'm going to be maybe the 235. I'll buy the 235. Maybe I'll sell the 232 half. And then maybe I will sell, wait, one moment, the 235. I'll buy that call and sell the 232 half call. And then I will buy the 220, wait, that's the diagonal, sorry. 235, 235. And then we'll use the 220, 220, 220. And if you see this, this is a bit, wait, no, 235, 235, 220, 220. Now, this is pretty interesting. You see that your theta is still positive, yet at expiration, you are slightly negative theta here. Do you suspect that price is going to be somewhere else than here? It's not going to be here. So it's either going to be here, it's going to be here. When you have this decision to make where you're saying, okay, well, price, I'm not entirely sure where it's going to go, but I know it's not going to be in this location. When you look at the volume profile, or you look at these high forecasts and the low forecasts in the channel, you can basically say, well, I don't think this is going to hang out here for too long. So now you have an even wider stance where you're saying, okay, well, your theta positivity is from 217 all the way to 240.62. Now, this is that's a good range to be in for a positive trade. Of course, this area you have to be careful of, because you're going to, if you sit in the position the entire time, you're going to actually lose this net debit. So this is a position that you want to set a profit target for, and you want to basically scale out of the position, scale in the position, uh, and enter and exit. Now, this is this is a nice position because you're saying, okay, well, I think it's going to be here or here, and in the event that it's here or here, we're profitable. Now, this is a nice wide range. You just know that it's not going to be in this position, and if it sits here and it just um, oscillates in this position, great. Here too, perfect. But we do kind of want this structure to be positive. I mean, you want it to be in a theta positive location, such that you're positive throughout from here to here, and you're not really worrying too much. So what can we do? We can say, okay, well, let's actually bring them a little bit closer together, and boom, just like that, we have an increased debit location, but we've also increased theta. We've increased a little bit of risks to the which is fine because now our our theta is connected positively. So your area has now increased of where you are your P&L positive, and this threshold is from 220.67 to 236.67. Now, this is the structure that makes perfect sense to me. Use the high forecast um, as the calendar side. Use the low forecast as the put side for the double calendar. I hope that explains a bit about how the double calendar is constructed and how you have the potential of legging in and legging out using both sides of the expiration or both sides of the call input also. Thank you.